I would definitely be on guard in Apple. And when you look at Apple and look at the kind of the ascending action of that one, if you just want to kind of draw that in there, they've been doing a very good job of holding that in this uptrend. So any break of the uptrend, right, this could be, pretty dramatic in terms of the level. Now, I would say when you look at, let me go back over to Market Watch and show you that, because I had talked about this in the cocktail hour in terms of the stocks that are expensive versus others. So if you look at this right in here, but if you look at, let's see, this one, I think I highlighted it properly. So that one right there. So this is actually Netflix. This one here is Amazon. So we have Apple. Apple is one of the cheaper ones. This number here, 56.59, is the where the stock or where the stock is, the implied volatility of that stock inside of the implied volatility range for the past year. So that's at 56% off the low. This one's at 86, this one's 70, this one's 68, 65. So just to show you that these are, and again, maybe that's booking. We don't really care about booking, but you look at these couple in here, you say 85. Well, again, that is Meta, and that's, again, more on the upper side of that spectrum. We still have a couple days to go, so that could continue to move higher. But let's look at each individual ones of these and show you where and what we're talking about. So if I go to Apple at that 56%, what I'm showing you is that when we look at the implied volatility, we're at about halfway in the middle of this zone. So if I were to take a 43 and going back a year, something like 13, so I should be somewhere in the middle. So 13, let's say 43, so it should be somewhere around 30, which we are. And this is the 30-day implied volatility. So we're getting a good gauge here, and it's not too expensive. It's not too cheap, right? Again, I'm not going to say it's just right either, but when you look at it from the bigger picture, right, is a November 1st option, right, worthy of playing if you really think you're going to get a bigger move or potential of bigger moves, right? Do you think it's going to be the upside or downside? You really like the cheapness of the implied volatility. Maybe you do want to buy some options in here and take advantage of something like that. Your straddles only, let's see, we're at 31. So let's just say the 32 level. So you're at 935, which is not too bad, right? Not too bad in terms of the potential. And do you think it can move beyond 935? That's the question, right? And then I would say from a chart perspective, okay, I try to look at the most recent swing high and swing low. We're sitting at 230. I think we could definitely get back up to that 237. I definitely could think we could get back down to the 220. So maybe it's a little bit expensive. And then I think what you want to add on is the potential for if we do get a bigger break, right? So we do have some negative news. Can it drop down below here? Can it make a low back down to maybe 214? So that's really where you would make your money if you were having or buying let's call it buying the implied volatility or buying a straddle or strangle in the stock. You really needed to make that secondary move beyond your the closest swing high or swing low. And that's potential. Great news would probably break it out. You can easily get more than that $7 right in there. Or to the downside, I think you could easily get that if it starts to break in a bigger picture. Now,